Hey YouTubers, Jaden here. So today we're going to go through 7 reasons to refinance your home loan in 2018. If you've got a home loan, you're probably getting bombarded at the moment, from your next door neighbor to the 7 o'clock news to probably the local Uber driver, all talking about interest rates going up and refinancing. But is now a good time to refinance? There are a few different situations where refinancing your loan could make sense for you. So let's go over a few of the main reasons for you to refinance in 2018. First up, what is refinancing? Refinancing your home loan basically means changing your existing loan for a new one, and in most cases, a new bank. The 2 main reasons people look to refinance their loan are A, to reduce their loan repayments or get a cheaper rate, or B, basically increase their existing lending. You can refinance your home loan from any bank or lender you choose, and it doesn't necessarily need to be your existing lender. These days, banks don't reward loyalty, and in most cases, we find lenders offer better deals to new customers rather than rewarding existing ones. So what are some reasons to refinance your home loan in 2018? Reason number 1, I want to reduce my home loan repayments. If interest rates have changed since you got your original home loan, you could be able to refinance into a new loan with a lower rate. By refinancing your loan, you can also reduce the amount of interest you pay, reducing the monthly repayment, ultimately meaning you pay less over the life of the loan. At Hunter Galloway, we find in most cases, if you've had your home loan for over 2 years, you're probably on a fairly uncompetitive rate. Let's say you currently owe $500,000 with an interest rate of 4.5%, and your current monthly repayment is $2,533 per month. So if you looked at switching your loan to a cheaper rate, say something that's on the market at the moment paying about 3.75%, you could potentially save a bucket, but we'll get to that in a second. First of all, by reducing your home loan rate to 3.75% from 4.5%, your repayments are reduced by $218 per month. So you're saving $218 per month just by refinancing your rate. Pretty crazy. That's not the best thing of all. The best part is the power of compounding interest. So you've got to remember you've got a home loan over 30 years. And although going from 4.5% to 3.75% might not sound like a lot, over 30 years, you would be saving over $78,000 in interest, like you can see here from the asset calculator. $78,000, man, it's crazy. Power of compounding interest. Reason number 2, my property has increased in value. Broadly speaking, property prices in Australia have increased over the last 5 to 7 years. If your property's gotten a bit of a boost, you might be able to refinance and get a better deal. These days, banks give better interest rates to borrowers who have more equity. So, using the same example before, if you bought your home for $500,000 and had a loan of $450,000, that means you had 10% equity when you bought the property. But if, since you bought that property, say you bought it 4 or 5 years ago, the property's value has increased from $500,000 to now be $600,000, it means your equity has increased to $150,000. So it's gone from 10% equity to 25% equity. The benefit of this is that these days banks are willing to give bigger discounts for when people have larger amounts of equity. So it means today that you could have or be eligible for a much higher discounted rate and be able to reduce your loan repayments, helping you pay off your loan much quicker. Reason number 3, my fixed rate period is expiring. In Australia, it's super common for people to have a fixed rate between 1 to 5 years. When the fixed rate term ends at that 1 to 5 year period, it generally rolls back to a variable rate. And in a lot of cases, the banks will roll this back to their standard variable rate without a discount. That means you could be paying tens of thousands of dollars extra on your loan because you're paying the standard variable rate without a discount. Now, the way to fix this and the way to avoid this is either looking at switching your rate again, it's actually checking that you're on a discounted variable rate, or looking to refinance and save a chunk of money. Reason number 4, I can afford to pay more on my loan per month. For some people, reducing the length of the loan term can help you pay off your loan quicker. So if you can afford higher monthly repayments because you've had an increase in income, because you might have gotten a bonus, or for whatever reason, you could potentially refinance your loan and get a shorter term to help pay it off way quicker. In this case, you could look at reducing your loan term from 30 years to 25 years, helping you pay off the loan faster, saving you literally tens of thousands of dollars in interest payments over the life of the loan. So let's go back to the example from before. Let's say you've got a loan of $500,000 and you're currently paying 4.5% interest rate. If you were to refinance that loan to a lower interest rate of 3.75%, you'd obviously save $78,000 and your repayments would be $218 per month less. But if you were to keep your repayments the same as they were when you were paying 4.5% per month, so if they were still the $2,500 per month in payments, you would actually be paying more because your interest rate's lower, and you would save $133,000 in interest over the life of the loan by making those extra payments and having the lower interest rate. 130 grand, 133 grand. It's crazy. And you basically save, $400 a month equivalent over the life loan. But the kicker is, because you're paying this loan so much quicker, you're literally cutting off years from your home loan. So in this case, you would pay off your home loan 52 months earlier or 4 years. You count 4 years off your home loan by refinancing. Crazy. Just check your statement, please. Reason number 5, I want to increase my loan and cash out. Now, I'm not talking about cash out like at the casino. A cash out refinance allows you to use equity from your home to borrow money at a lower cost. You might want to use these funds, not for the casino, but to invest in shares, to use as a deposit as a new investment property, for a bunch of things, obviously to make more money. But how exactly does increasing your loan work? Well, let's use the example above again. So let's say that you bought your home for originally $500,000 with a $450,000 loan. Since then, your home might have increased in value to $600,000, but you've still got the $450,000 in loans. That means your net equity in that property is the 600 minus 450 equals $150,000. Ew! Hold on, don't get too excited yet. The banks obviously only lend up to 80% on the loan amount. So what you need to do is then go 600,000 at 80% equals 480,000 minus 450, which leaves you with $30,000 in equity you can withdraw from the property to do other stuff. Now, you can potentially borrow above the 80% or $480,000 by using lender's mortgage insurance, but this amount can range from a few $100s to a few $1,000s. So it's worth having a chat to your mortgage broker to make sure that you're not going to pay too much in lender's mortgage insurance just to pull a bit more equity out of the property. Number 6, I want to do some renovations. So you might have bought the property 5 years ago for 500 grand. The kitchen might be starting to look a bit tired. You might be ready to do some renovations and be thinking, instead of using cash out of your own pocket, you can use the equity in your home. Sure, not a bad idea. But how do you do that? Well, let's start with the 2 categories that renovations generally fall under. 1, you have simple or cosmetic renovations, and 2, you have structural or more complicated renovations. Let's start with the simple renovations. Simple or cosmetic renovations are exactly that. They're basic stuff that involves, say, painting a wall, putting in an air conditioning unit, or maybe some solar panels on the roof. It's stuff that you can get a quote and get done tomorrow. And these type of renovations works exactly the same way as the cash out and equity that we talked about in the example earlier, where you're just relying on the current value of your property, you're increasing the loan, you get that 30 grand out and potentially use that to go and paint the walls and make the place look really nice. Now, structural renovations are where it gets a little bit more complicated, but still super achievable. Structural renovations are generally when you're adding more value to the house. So it's stuff that you need to get a builder involved with. If you're adding, say, a bedroom, if you're extending the kitchen, if you're putting a huge patio thing or building under the house, it's big, a big scope of work. Now, generally with structural renovations, you'll be adding value to the house, therefore you'll be increasing the value of the house. So you can actually get what's called an as-if complete valuation. So again, let's say your house was worth $600,000. And then let's say that the works were about $100,000 and they're going to add $100,000 of value to your home. So now your property on completion would be worth $700,000. The bank would then use that $700,000 to lend against. So they would do $700,000 at 80%, which gives $560,000 in lending, and means you could actually increase your loan from $450,000 to $560,000 to pull out $110 grand to do your renovations. Don't have to use your own money. Great. Now, last one, number 7, is I want to consolidate some debt. Put some personal loans and some credit cards, stick it on the home. Now, this is one you've got to be a bit cautious of, but let's start off with what it is. Consolidating debt is basically that. It's grouping together your existing credit cards, personal loans, HECS debt, maybe. You probably shouldn't do that. It's more for things that have high interest rates that you want to obviously lower the interest rate, put it on a home loan rate, and potentially make your monthly repayments a bit more manageable. Because on those high interest rate loans, you could be paying big amounts per month. Now, a debt consolidation works in a similar way to a cash out refinance, where the increased portion of the loan is where the property is valued at its today's value. You pull out the increased equity. So in the example earlier, you'd have $30,000 to pull out, and then you'd use that to pay out your personal loans, your credit cards, your car loans, and that sort of stuff. Now, like I said earlier, debt consolidation works well if you're paying 20 or 30% on those car loans and you want to get those costs down a little bit. But where people can get trapped is not realizing that by putting on your home loan, you're potentially changing it from, say, a 5-year personal loan that it's going to be gone and paid off in 5 years to putting on the home that could take you 30 years to repay. So the cost can actually end up being more. So you just need to make sure your mortgage broker does the numbers on this and does a like-for-like comparison to make sure you're not carrying those costs or those personal loans or that holiday you had a couple of years ago, on the home for a couple of years, for 30 years, because that could cost you tens of thousands of dollars. So what do you think? Is refinancing right for you? Well, while there's heaps of benefits to refinancing, you just need to remember that there are some costs to do this. There's application fees, there's government fees, there's sometimes exit fees, and these can range from say $500 to $600. But like you can see in the example earlier, paying $600 to save $78,000 is a worthwhile deal. Now, with that being said, there is some good news out there. At the moment, there are a bunch of banks giving refinance rebates. So what that means is by switching to that bank, they'll give you between $1,000, $1,500 and up to $2,000 to refinance your home loan and cover the cost of that move. So that's great to be able to do that. And there are some terms and conditions. There's minimum loan amounts of say $250,000. You need to be able to move from an external bank to that bank. There's a couple of general terms and conditions. Talk to your mortgage broker or drop us a line and I'm happy to help you out on that. So what did you think about that? What was your favorite point? What's your reason to refinance, or what would you think about? Would you consolidate debt? You think it's a good or a bad idea? Leave a comment below. Would love to hear from you. And if you've got any questions, get in touch. Thanks, guys.